All right. Well, thank you so much for all of you attending this month's webinar, March 2023. Let's hop right into it. We will start with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risks and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor such as myself or a tax professional before implementing any strategy discussed within the presentation. And of course, past performance is not indicative of future results. You can find additional disclosures on our website. And throughout the webinar, if you have any questions, please submit them at the bottom of the screen using the Q&A button. Quick bio. My name is Jeremy Eppley. I'm a chartered retirement planning counselor, accredited portfolio management advisor, and accredited investment fiduciary. You can learn more about my experience and qualifications on my LinkedIn. And Silverstone Financial is a fee-only fiduciary registered investment advisor. We provide wealth management, financial planning services, and you can learn more about us on our website. So this month, we're going to start it slightly differently. Instead of going over news and such, I wanted to go over performance of the markets. It was an interesting month in the markets. Not that much happened, if I'm honest. It was somewhat expected. It was somewhat in line with what I had laid out as one of the possibilities last month. I will go over what differed and such in a few slides from now. But I wanted to point out an interesting, takeaway that I had is that there has been in January and in February a shift back toward higher beta stocks or risk on investments, if you've heard of that before, basically away from value and more toward growth or other kinds of investments that would be traditionally considered a riskier investment. So the Dow Jones in this lineup of indices usually shows the more value-oriented side of the market. It has industrials in it, usually has lower PE, price to earnings stocks that show that they're usually more mature companies and you can get, quote unquote, a better deal in terms of the price to the earnings of the company. And in 2022, those did significantly better than any kind of high beta, high growth, no earnings stocks that were losing money, but in the anticipation in many years from now that they would have great growth, great profit potential, but were currently not profitable. So a lot of investment advisors, commentators, investment analysts, I saw a lot of them recommending quality and recommending to hold value. I was also in the camp of investing in quality names, so names that had ironclad balance sheets, usually Microsoft or Johnson & Johnson come to mind when you talk about great credit ratings, great balance sheets, companies that would outlive many governments in terms of how well capitalized their companies are. But what we saw was as economic conditions held up and inflation came down, there was a quick reversal toward those growthier names. And I put a little a spectrum arrow this month showing that the Dow Jones I would consider the most value heavy, and then it goes more a blended benchmark, more core benchmark. Mega cap names are usually the large tech names that are more growthy, and then small caps are often seen as riskier than the mega caps or even the mid caps. So you can see that as we got to higher beta names, we performed better. There was more selling off in the bid up value names. So it's interesting to see, which I'll point out how it continues on the next slide. We see that year to date, including just to see this month. The global economy or global stock markets performed in line with the US markets, sold off a little bit because they had been bid up at the end of last year a little bit, but they gave up some of those gains, but not super significant. This month was pretty, I would consider this a flat-ish month. It did have some losses, but it didn't have those 8% losses that we saw some months last year. Bonds were relatively flat, but still seeing 2% loss on bonds in a normal year for a single month would be alarming. But bonds have been volatile. They've given up a lot of their gains in 2022, and we expect to at least see that a little bit in 2023 because of course, the rising rates affect bond prices. Gold fell drastically this month, worst performer out of all the indices, still bucking the trend of being a reverse or an inverse play, and interesting to see. But there's always that potential that it could start coming back, especially if traditional fiat currencies or other kinds of fiscal policies were seen as dangerous. There's oftentimes we see fleeing back to gold. Crude oil, I consider this pretty flat for crude oil, especially how volatile it has been. And Bitcoin, which is interesting to see, was the only positive indice of these, being roughly flat, especially for Bitcoin, less than 1% change in price, but only green ticker on the map here. Quick recap year to date. We're still green year to date. There was sell-off this month, but January was a really great January. I forget the statistic that I had mentioned last month, but I believe it was like the best January performance in 20 years or something like that. So even though we had a slight or moderate to slight loss this month, we still see solid return year to date for the past 2 months. We still see that holding true, the high beta names returning better, these small caps, the mega cap growth, the mid cap, or not the mid cap, the more blended S&P 500, and that Dow Jones that had been bid up quite a bit last year, giving up 1.5% while everything else was returning pretty well. Global X US still up for the year, even though it had the worst performing this month of the indices. Aggregate bond flat, which is interesting to see, especially with potential higher rate hikes, which we'll discuss in the next couple slides. And we see the gold being somewhat flat even after quite a bad month this month, but it had quite a good month in January. Crude oil, again, 4%, not super significant, somewhat flat, but a loss. And Bitcoin, the real big star here, had an incredible January, and even with a very slight February performance of less than 1%, over 40% return for year to date. Incredible bounce back, especially after the really terrible year of, I think it was down 70% or something for the year in 2022. Interesting to see all the different performance here. So last month was relatively boring, not too many notable events under the radar. The biggest one happened near the beginning of the month, was very interesting to see. It was extremely shocking to me and a lot of commentators. It was the jobs report blowout. I think it was one of the largest upsets, at least I've seen in my career, we had 517,000 jobs added when only 188,000 were expected. So not too far off of 2.5, 3 times what was expected. Huge blowout, with unemployment rate falling to 3.4%. I think it was like 3.5, 3.6 expected. So we see really strong job growth and strong labor force, even though we had, if you remember, in December, in November, and even January, I think I had mentioned, looming fears of the job market falling off a cliff because we saw the big tech names, the Amazons and the Facebooks and everything, and they had fired quite a few of their employees. I believe just today I saw Waymo, which is one of Google's self-driving car bets, they laid off 8%. So it's interesting to see how even though we had a lot of fears that these big names were firing a lot of employees, and it was heralded as the beginning of the end, it was very much, at least what we've seen for this month, it has been just in that small industry of the tech industry, but a more secluded industry rather than it being a broad problem across the entire United States, which is good to see. Of course, we can see reversals in the future, but it's really just giving up a lot of what tech had done in the past 2 years during that pandemic. They hired. So they ended up letting go some of the employees just to help get them through what has been more difficult on the capital side. Their balance sheets have hurt with the inflation and such. So laying off employees is one of the quickest ways for the big tech names to make Wall Street happy. So we'll see how jobs will continue over the next months and for the entire year, but huge blowout, very strong job growth, which makes the whole situation with rising rates, which makes you think of potential recession. And with potential recession, that means jobs being laid off, economy slowing down, GDP contracting, all this stuff not exactly happening, and inflation is coming down. So we had heard, oh, it's going to be a hard landing. Well, it could be, a softish landing. We heard like in June, July, August, and then we heard like the softish landing and getting more confident with the commentators talking about, oh, well, softish landing. And I have heard since January now the phrase no landing, which I don't know if we'd be calling it that. I think it's, perfect landing would be a better term instead of just, I guess, floating forever. But I've been hearing more and more commentators having at least saying there's a potential that we're not going to have a terrible crash and the economy is going to fall apart and there's going to be lots of layoffs and there's going to be a huge recession. We'll see. I'm not in the boat of the no landing. A lot of the raising rates takes 12, 18 months to make its way through the economy. So they're still raising rates. We will see the impacts in 12 months. So too early to say, but seeing these reports is really incredible. However, we saw inflation month over month and the inflation rate not doing as well as we had hoped. We had seen, if you see this month over month chart, we had 0 and then relatively low, especially in comparison to the beginning of 2022, and it dipped back down. And then this was the job report, or the inflation report for January, a huge tick up from 0.1 for the month to 0.5%. Of course, that is, half, is far way off of that 1% that we saw at the beginning of the year, and then the 0.9, and this one off the chart at like 1.2, I forget the exact number, but still big jump up month over month. And expectation, the consensus for the annual rate was higher than hoped, higher than expected. And even though it was lower than previous, we still see these higher bars ticking off. So we're seeing the overall inflation rate for the trailing 12 months for the year. We're seeing that reduce, which is good. But that month over month and such, worrisome. There was a lot of arguing among economists of what the Federal Reserve is going to do. I'll switch to this slide. The exact same slide from last month. We had the Federal Reserve meeting on January 31st and February 1st. So that was January, February meeting. We had essentially no meeting this month. And we don't know what the Federal Reserve is going to do. But with the hotter than expected inflation, even though we had cooler than expected inflation previously, the 50 basis points hike is back on the table for a lot of commentators. And with a 50 basis point hike, that's hiking significantly more than expected, which of course has fears for the economy, fears for the stock market and such. But I'm still in the camp. They're probably going to do 25 in March, and they might do another 25 in May. It's definitely increased likelihood of a 25-0 to a 25-25. Still unlikely to be doing a 50, especially since they had slowed down in the January meeting, but we shall see. interesting position in the year. We just finished up February, which is historically a flat-ish month. Especially historically, we see a negative return if we have a positive January, which is what happened. I'll show you that more in next slide. But we're back into historically seeing March and April as positive months, some of the higher positive months behind December and November. So next 2 months, if we're going by historical trends, we will see positive returns. And honestly, that's what I expect. I wouldn't be surprised if we follow this trend. A lot has been lining up for how history has shown charts. When I look at the charts today, I see a lot of similarities. So positive January, negative February, probably 2 positive months, and then more problems in the end of Q2, beginning of Q3. I wouldn't be surprised if we follow this trend, but we shall see. So this is our last slide. We're going to spend a little bit of time on it. This, if you recognize it, I copied the same annotations that I had last month. I wanted to show what the annotations look like after we have more data. Of course, this box over here, this February month, we didn't see last month, even though these are the same annotations. They're very, very basic charting lines, like nothing too complex, just tips over here, the peaks of each of these going all the way down and following these bottoms, crossing over. And we see, a but a run up that gave me some reminiscence of end of June, beginning of July over here. I had said that it wouldn't be as dramatic of huge sell-off, huge bounce back. It'd probably be more toward that magnitude, but a lot of that pent up demand, you can see how explosive when we see positive economic data, how explosive the markets can be. They can really bounce back quite quickly. And I believe if we had a better inflation report in the beginning of February, we would have seen quite a positive February. But we had in the beginning of the month, we had a positive Fed, we had strong jobs report. Then we had a few days later, the lackluster inflation data, which really cooled things down. And then what really, I guess, put the nail in the coffin, you could say, is this blue arrow pointing out it was the PPI was also hotter than expected. The PPI is the producer price index rather than the CPI, which is the inflation rate, is the consumer price index. So both of them were hotter than expected. And so seeing that on both sides, it showed that inflation was a little more cemented, not beaten, easily done in the tailwinds, not to be worried about anymore. There's still that inflation concern. So a lot of the gains of smooth sailing were given up. Still, again, positive for the year. We had started the year here, so solidly positive, but not too terrible. We slowed down, it was a dip, and then we've really started trading in a rather tight range here. So I wouldn't be surprised if we saw something more like this, where we have a sell-off, trading in a range, and then some good news that makes us take off again in March. I want to point out, these are the exact same arrows that I had last month. And this was what I had said, my quote unquote prediction. I had like a light green arrow instead of this more darker green down here. And it was much flatter. And I believe I had said, not verbatim, that we would probably trade flat, but there was the potential to give up some of the gains. But if I had to guess, we would trend higher. And looking back at the data now, if we had positive inflation reports, again, that would have been a third or the fourth time in a row, then we would have easily trended higher. But because there's still some worry in the markets about what the Fed's going to do, how inflation is going to hold up and such, we saw that sell off. So overall, everything is acting how I would expect it. The shocking, quote unquote, or I guess I would say interesting continuation is that shift back toward the growthier names, away from the value and the quality, which a lot of people had positioned for. Most likely that's why it's happening. It was over positioned in quality and value. especially now that we have these positive news, we see that quick shift back to growth. So even though what you usually see is when stuff goes up, growth goes up, and when stuff goes down, growth goes down more than everything else. But you can't see in this chart because it's not the heat map that we've seen before. But when this was going up, growth really pulled this up, and we saw the sell-off of the value. That more a lot of the industrial names in the Dow Jones and such, seeing the Dow Jones indice for January didn't keep up with a lot of the growth names. But even though we had the sell-off this month, we still saw positive or relatively positive returns from a lot of the mega cap names, the growth names, the small cap names, those names that aren't what would be traditional, vanilla, the more core, the more value oriented names, those still sold off more than the growth. So that was that reversal that continued in this downtrend, which I would not have expected. So with that said, essentially what I would take away from that is that the shift back from value to growth is cemented. I think it will continue, and those that position too heavily into value have missed the train, essentially. I wouldn't be surprised if growth is now investable again. I think I had said at some point in September or October that I had heard a lot of commentators, economists, analysts say that growth was not investable. And I don't think that's true anymore. Growth is investable, especially with 2 months of growth outperforming value, even especially in growth outperforming value in a reversal and a downturn this month. So that's it for this relatively quick monthly market update webinar. I think I saw one question come in. If you have any questions for me, please drop them in the audience Q&A using the button below. But I believe it was just the one question, and I had skimmed it. Yeah, it's more so a personal tax question that I can email you about. It wouldn't be appropriate for the monthly market update webinar where we talk about the stock market rather than personal taxes. But I guess that's a good reminder for all of us. Make sure you get your taxes in on time. We provide tax services and other kind of tax planning. Of course, it's too late for this year to get in the queue for tax returns. But if you're looking for taxes or other kind of financial planning, wealth management, any kind of service like that, please check out our website for those of you that are not already clients. All right. Well, thank you all for attending. I didn't see any other questions pop in, so I will call it a night. I hope everyone has a great rest of the month, and I hope next month when we're back here, I have some positive news. We see some green markets, and I'll tell you all about it. All right. Thanks, everyone. Have a nice night.